When it comes to investing and managing your own portfolio, it's so important not to just take a buy and hold approach. You need to perform your due diligence along the way. It's more like buy and monitor. Have a thesis on why you're entering a position, because if that thesis changes, it may be time to exit. And in today's video, we're going to take a look at the popular Magnificent 7 stocks, each one of them individually, and I'm going to give you my personal rating. We'll be taking a look to determine whether they are a buy, a hold, or even a sell. All 7: Apple, Amazon, Alphabet, Microsoft, NVIDIA, Meta Platforms, and yes, even Tesla. And before we begin, do me a huge favor. Click that like button down below. Subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And if you're interested in seeing some of the top stock picks from the Motley Fool, along with other great resources, then head over to fool.com/Mark, where you could check out their 10 best stocks to buy right now. All right, let's jump back to the video, taking a closer look at these Magnificent 7 stocks. And let's first show you just how dominant these stocks have been as compared to the S&P 500 over the past 18 months, pretty much since the start of 2023. As you can see here, NVIDIA has been the clear leader and has accounted for a huge chunk of the S&P 500 gains over those past 18 plus months, as the stock has climbed an incredible 621%, followed by Meta at 323%, Amazon nearly up 100%, Alphabet up 84%, Microsoft up nearly 70%, Apple up 64%, and bringing up the rear is Tesla up 61% over that period. Every one of those Mag 7 components easily outperformed the S&P 500 the past 18 months, really to no surprise. But as we know, this isn't sustainable, and it also kind of masks how poorly a large majority of those other 400 plus stocks have performed over that same time period. And the easiest way to look at this is by comparing the S&P 500 to RSP, which is the equal weighted S&P 500. This will show you the disconnect between those Mag 7 stocks and what they have done to outperform and really carry most of the load for the S&P 500, and then putting it all on an equal basis. Looking here, you can see that the S&P 500 gaining nearly 40%. Meanwhile, the RSP ETF is at 18% over that same period, one of the largest gaps we have seen in some time between both of these ETFs. Okay, now let's take a look at each of these Mag 7 components, going in order of what the performance has been since the start of 2023. Obviously starting with NVIDIA, stock ticker NVDA. And NVIDIA has really been the golden child for that time period there. They have led the change, and you really can't do AI without NVIDIA. Analysts are expecting the company to generate 2025 EPS of $3.55 per share. And over the next 3 years, the average growth rate is 52%. Even compared to these comps they've had the past few years, that's still quite impressive. This gives the company a forward PE multiple of 29.5 times, well below their 5-year average. But again, with these high growth stocks, we don't really put too much weight in PE multiples. Instead, I would rather look at the PEG ratio. And NVIDIA has a PEG ratio using that 3-year average growth rate of 0.57. Even with all the success NVIDIA has had and how much the stock has ran over the past few years, from a valuation perspective, particularly a PEG ratio, the stock still looks intriguing. And that's why I currently rate NVIDIA as a buy. Now let's take a look at what analysts think. And as you can see, analysts have an average 12-month price target of $144 per share, implying another 37% upside from current levels. And that leads us to our second stock, which is Meta Platforms, stock ticker META. And without NVIDIA, Meta Platforms would be the talk of the town. But there is NVIDIA, and Meta has had a fantastic 18 plus months. They too focusing on AI and how they can utilize it across all of their platforms. And in addition, the past few years, they've been focusing on how to get leaner, how to improve from an efficiency standpoint, and that has certainly been paying dividends. So much so that the company even started paying a dividend this year. Analysts are looking for the company to generate EPS of $24.20 per share in 2025. Over the next 3 years, the average annual growth rate sits at 24%. The forward PE currently at 21.1 times, well below their 5-year average, but again, not really focused all that much on PE multiples. Instead, let's look at the PEG, where Meta currently trades with a PEG ratio of 0.88. Again, a PEG ratio below 1 is very intriguing to me as an investor. And with a presidential election coming up in a few months, the run-up to that, there's going to be a lot more digital advertising. I already thought digital advertising was going to rebound, but this is only going to further compound that. In terms of my personal rating, I rate shares of Meta as a buy, as I really like the digital advertising space to continue its rebound. Now let's take a look at what analysts think. And as you can see, analysts aren't as high on the stock, as they have an average 12-month price target of $549 per share, implying only 8% upside from current levels. And that leads us to our third stock, which is Amazon, stock ticker AMZN. And if you've watched any of my past videos, you have heard me talk about my love and my appreciation for Amazon. This is a very diversified company, and they have a bunch of different levers that they can pull. They have AWS Cloud. How about advertising? That continues to grow. Retail, they have their own AI component, and much more. In terms of valuation, analysts are looking for 2025 EPS of $5.88 per share, which equates to a forward PE multiple of 28.2 times. Over the next 3 years, analysts are looking for EPS to grow at an average annual rate of 38%, giving the company a PEG ratio of 0.74. Again, another Magnificent 7 stock with a PEG ratio below 1, something I love to see. But even more importantly, Amazon gets all the attention when it comes to cloud. AWS is the largest cloud provider, but what they don't get enough appreciation for yet, I believe, is advertising. They're now the third largest digital advertiser on the market, and that continues to grow. Again, they have a lot of levers they can pull. For me, when it comes to rating Amazon, I rate them as a buy, as I believe this is a company that still has a ton of growth ahead, so much so that I'm continuing to build my position in the stock. And I want this to be my largest individual holding quite soon. Now let's take a look at what analysts think. As you can see, analysts are high in the stock, as they have an average 12-month price target of $224 per share, implying 35% upside from current levels, telling you they too are high on the growth moving forward. And that leads us to our fourth stock in the Mag 7, which is Alphabet, stock ticker GOOGL. It's pretty funny, the past 2 stocks that we talked about all had a digital advertising component. Now we come to the king of digital advertising, which is Alphabet, owning the 2 largest search engines in the world, with Google Search and YouTube, where you're watching this video today. Alphabet is also looking to gain respect as it pertains to AI. The company has made a ton of headway. Now, their rollout of AI hasn't been that great, but they are a long way and not too far behind Microsoft and OpenAI, looking to implement this into those 2 large search engines. Alphabet is currently my largest individual holding, but as I just mentioned a second ago, don't be surprised in the near future when you see Amazon as that top spot. But just like Meta, Alphabet also decided to pay a dividend for the first time this year. In terms of valuation, analysts are looking for 2025 EPS of $8.64 per share, which equates to a forward PE multiple of 18.8 times, well below their 5-year average of 25.7 times. And over the next 3 years, they have an average annual growth rate in terms of EPS sitting at 20%, giving the company a PEG ratio of 0.94. Again, another Mag 7 stock, another PEG ratio below 1. And as I mentioned, as it pertains to Meta, I'm really bullish on the digital advertising space. And when it comes to rating shares of Google, you know I got to rate them a buy, as I'm really bullish on the forward momentum and the growth, especially into the fall, as it pertains to digital advertising. Now let's take a look at what analysts think. And as you can see, analysts are also high on the stock as they have an average 12-month price target of $205 per share, implying 26% upside from current levels. So as we've seen so far, the top 4 stocks in terms of performance are all still rated as buys. Now let's move on to the 5th stock, which is Microsoft, stock ticker MSFT. Microsoft has changed spots with the likes of Apple and NVIDIA over the past 6 months or so in terms of being the top dog in terms of market cap here in the US. And the company, like I mentioned with Amazon, has a lot of different levers, a very diversified company. Whether we want to talk about their online suite of office tools, whether we want to talk about their AI with OpenAI and their investment there, or whether we want to talk about their hardware, or how could we even forget other things that they have, like maybe Azure Cloud, which happens to be one of the largest cloud providers in the world. Again, a lot of levers for Microsoft. It seems like everything that Microsoft touches turns to gold, and the company has done a fantastic job moving into more of a subscription model, gaining that annual reoccurring revenue that investors love to see. In terms of valuation, analysts are looking for 2025 EPS of $13.19, which equates to a forward PE multiple of 30.6 times. That's below their 5-year average of 34.7 times. And over the next few years, analysts are looking for average annual growth of 15% in terms of EPS, giving the company a PEG ratio of 2.0. Microsoft certainly doesn't grow as fast as it once did, but for a company its size, more than $3 trillion, growing at 15% is still pretty impressive. For me and my rating, I love Microsoft, but all of these Mag 7 stocks can't be buys. So although I own the stock, it's not one I'm looking to add to at these levels, and therefore I currently rate shares of Microsoft as a hold. Now let's take a look at what analysts think. And as you can see, analysts are still high on the stock as they have an average price target of $503 per share over the next 12 months, implying 25% upside from current levels. And that leads us to stock number 6, which has long been one of the most popular stocks on the market, which is Apple, stock ticker AAPL. And like Microsoft, Apple actually held the top spot in terms of market cap for a number of years. But now recently, Microsoft and NVIDIA have caught up and even surpassed Apple as the top market cap company. However, although Apple is large, it certainly isn't growing as fast and really hasn't been growing all that much from a fundamental perspective over the past few years. Thus, it should be no surprise that when we look and compare all Mag 7 stocks, that Apple is on the lower end of the spectrum in terms of share price appreciation. However, where you do have to give the company credit is in growing their service revenue. That continues to become a larger piece of the pie. Now, not a huge piece yet, but it continues to grow. And those service dollars are huge margin for the business. So as service revenue continues to grow and become a larger piece of the business, I expect operating margin to continue to grow for the company as well. In terms of valuation, analysts are looking for 2025 EPS of $7.47 per share, which equates to a forward PE multiple of 28.5 times, above the company's 5-year average of 25.3 times. And they have an EPS 3-year average annual growth rate around 11%, giving them a PEG ratio of 2.6. So as you can see, no real value as it pertains to a PEG ratio. But again, as I mentioned, Apple hasn't been growing all that much. Really, not at all. The slowest among all Mag 7 companies. For me, I personally rate shares of Apple as a hold, as I think Apple needs to find another growth driver again, as the company has masked its EPS growth of late over the past few years just via stock buybacks. And I love buybacks and all, but I also want to see a company grow. Now let's take a look at what analysts think. As you can see, analysts still like the stock as they have an average 12-month price target of $249 per share, implying 17% upside from current levels. And that leads us to our 7th stock on the list of the Mag 7, which is Tesla, stock ticker TSLA. And if you've joined us for our Investing Power Hour, my weekly live show every Wednesday at 7 p.m. Eastern Time, you've heard me talk about Tesla. and my frustration as it pertains to Elon Musk. Elon Musk, a great innovator, great mind, terrible leader. He gets all of the Tesla fanboys and fangirls all riled up about future, down the line, decade down the line products that may come out or may never come out. We've been talking about self-driving for what seems like a decade. We have the same Tesla cars that we had a decade ago. We had a Cybertruck that was something like 3 to 5 years, well past its due date on when he first started talking about it. And the delays kept coming and coming. This is a leadership where they over-promise and under-deliver. Now, I've been in business for quite some time, and it's usually the opposite approach that you want to take. Under-promise and over-deliver. As it pertains to valuation, analysts are looking for the company to generate 2025 EPS of $3.18, which equates to a forward PE multiple of 62.5 times, well below their 5-year average, but again, not something we pay all that much attention to. Analysts are looking for EPS average growth of 40% moving forward, giving the company a PEG ratio of 1.56. You never know when it comes to Tesla. A lot of instability. You don't know what you can trust from this management team. So when it comes to owning Tesla, not really a stock that I want to own all that much. When it comes to trading Tesla via options, that's something I do on the regular. A high multiple stock and the instability that comes along with its leader is a stock I want no part of, which is why if I owned it, I would rate the stock a sell here, which is going to shock a lot of you that are new or love Elon or love Tesla, and I get that. But based on my investing style, this is a stock that is too unstable. Now let's take a look at what analysts think. As you can see, analysts are more in line with me, as they have an average 12-month price target of only $212 per share, implying only 6% upside from current levels. The worst of all Mag 7 stocks we looked at today. So there we just focused on all 7 of the Magnificent 7. Went through them in order based on what we've seen in terms of performance over the past 18 months. Down in the comments section below, I want you to let me know what is the 1 or 2 stocks within the Mag 7 that you would buy at today's prices for the foreseeable future. Something you want to hold on to for the next 12, 24 months from today. And if you haven't done so yet, show your appreciation by hitting that like button down below. I truly appreciate it, and it really helps the growth of this channel. And if you haven't done so, make sure you subscribe to the channel so you're notified anytime we have new videos or we go live. And with that being said, we'll see you in the next one. Take care.